Multifamily is under attack. The FBI has just raided a developer and property manager, Cortland, in relation to this probe related to revenue management software and so-called price fixing. If you're a multifamily owner, investor, really anyone that cares about free market capitalism, the ability to do business in the United States without being encumbered by a radical Justice Department, you need to pay attention and you might need to do your part. This is the time where we have to stand up to just bogus policies and enforcement on free market practices that we're literally just getting pricing information to determine where we're going to set our rent levels. So multifamily investors and owners, this is a call to arms to support some of these companies and businesses, not necessarily as a blanket, broad brush, but we need to push back on the narrative that we can't use technology to help us set pricing. Do it in all other types of industries. Housing seems to be a little bit different just because, landlords are evil and, you shouldn't be able to own property, and a mentality that is incongruent with American capitalism. So we're going to start there, but then going into the National Association of Home Builders, because there is a divergence in construction for single family and multifamily in different geographies. But why is that? We're going to dig into it on the Gray Report. And then from Newmark, for the first quarter 2020-24 capital markets report, CRE investment is way down, as you might expect. But why is that? We're going to get into the details. And then Yardi Matrix is blessing us with another 2024 from May National Multifamily Report. Rent growth is not as strong as some may have hoped. We're going to get into exactly why and what that means for the rest of 2024 and potentially interest rates as well. And then finishing out this episode of the Gray Report, giving you another update from Apartment List, their national rent report for May 2024. You're going to watch the entire episode of the Gray Report. Make sure you're subscribed to the Great Capital YouTube channel, like this video, and then press the bell icon so you can be notified as soon as we have posted an update or a new episode. All right, Dr. Bosnagel is back in the seat after his trip from Italy. Let's get into it. Welcome back to the Gray Report. I am joined finally again, by Dr. Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. Matt was out, not on assignment, but on vacation. Beautiful in Italy. How was your trip, Matt?
Yeah, it was good. There were a lot more stairs in this than I hoped.
That's the only feedback I've gotten from you so far.
It was really wonderful. It was a beautiful place, and hopefully I'll go back soon, and
good.
I'll be in better shape.
There you go. Perfect. So before we get into this BizNow article that's getting into this just unprecedented raid by the FBI to a property management company, I mean, again, we don't know all the details. I don't want to, be hyperbolic and say they came in guns blazing, but, the FBI often can do that. Mm-hmm. But Matt, first, I want to just let everybody know, a quick update.
Yeah.
If they are accredited investor, Gray Capital, we do have a new investment opportunity. It's live on the Gray Capital portal. You can start getting information by going to solanaindy.com or to graycapitalllc.com. Create your account on your portal. Learn more about this investment opportunity. Incredible 384-unit Class A asset on the north side of Indianapolis, right in Gray Capital's backyard, right up the street from our headquarters, down the street from where I live. Beautiful property, great, strong returns. Love to discuss it with you. So hop on the website to learn more. Okay, back to this raid.
Yeah.
Matt, bring us up to speed for those that haven't been following.
Okay.
What are we talking about? Why did the FBI break down the door and go through their files? I mean, is it terrorism, drugs?
No, this isn't.
What's going on?
This is in connection, reportedly, with an investigation into RealPage that is being brought by the Arizona Attorney General against RealPage for what they think is price fixing in the apartment industry. I will simplify it, and you can...
So this is an FBI raid, though, right?
Yes, and I don't understand what the difference is between the federal action
U.S.
and
Department, the DOJ has also a case against RealPage right now. So is this a related but separate?
I'm not sure
or in
because
connection?
I think that it may be related. I'm not sure the specific details because really a lot of the articles about this is particularly even
this just
the
happened
Biznow
also. This is breaking.
This place manages 18 Arizona properties, and there are 400 properties in this lawsuit that that the Arizona Attorney General has against RealPage, and there's not a whole lot of facts beyond that. Cortland has said that they have cooperated with the investigation and all this, but I think this is all going to play out in whatever lawsuit, if it happens, when it happens, or whatever happens.
And give us the background, though. What's the idea behind the Arizona AG or the DOJ? What's the problem with what Cortland and other companies? And I know a lot of the focus is on RealPage and some of the revenue management software, their pricing algorithms that make suggestions to property managers on where to set the price. What's the issue here?
I think that the general idea is that.
Is it because the headline is price fixing scheme? Yeah.
So they think that RealPage is telling all these rentals, increase your rents, increase your rents, increase your rents, and the landlords are clicking yes, yes, yes. They're not really thinking about it. They are doing exactly what RealPage is doing, and they are saying what RealPage is doing is elevating rents.
So it's illegal to raise rents? Is that the problem?
And I think that they are saying because RealPage has software spread out through 16 million apartment units, the size of that could make or break the market. And that's what they're saying that it is doing.
Using information and data to inform pricing decisions is illegal?
That's what they're saying, allegedly.
Well, so when anyone trades, I'm thinking about the hotel industry. Yeah. I'm thinking about the airline industry. I'm thinking about Uber. I'm thinking about the stock market.
Yeah.
What
about Wendy's too?
Wendy's. Is it just because housing is a sensitive subject?
Yeah.
And the idea of the rent is just too damn high, which the rent is high in some places. It's also low in some places. And is it is it just eat the rich? Let's all string up the landlords.
Well, I think
is is this a political push? Is that the impetus, or are there real crimes? Is there actual collusion going on? And what law? And I know the DOJ does point to specific price fixing laws, but compared to again other practices in other industries, and it doesn't even seem like they're even coming close to violating that law. I don't see the problem. And you think they even understand?
That's what I was going to say. It is based on a set of assumptions and misunderstandings about RealPage software and about the rental market in general that need some updating. First of which is that rents have declined by RealPage's own data for greater than a year almost.
Well, that's a good point. It doesn't just make suggestions to increase rents.
Yeah.
It will make suggestions to decrease rents as well. And so
that's the first assumption is that RealPage is uniformly and has been actively raising rents more than they should be, which is kind of demonstrably false. Now, you could argue that rents would be much lower than they were otherwise, but still, it's hard to argue that.
The reality, so there is some truth to that. The rents on average may be lower if groups were not using these types of pricing tools.
Yeah.
But you also can make that conclusion based on the frequency. And it's more related to the frequency when you're really examining your price levels. Old school, back in the day, you might look at your rents once a year. This 2-bedroom, again, I'm going back in time, is going to be $800. And that's the price for the year. We're going to put it on the flyer. It's going to go on the sign. It's $800 all year. And you know what? It may not even change next year. Maybe it'll be $815 or $825 or $850, whatever.
That would be my second pair of assumptions. So it's maybe 1.5 is that they think that the transaction and the turnover in apartments is perhaps maybe a lot lower than it is. A good 50%, in a lot of apartments have new renters that come in. And so, and this is the connected assumption, not only is there a lot of turnovers, which make for a fluid and reactive market and not one that is just set in stone all the time, but also that renters have a great deal of choice, and they also can go to apartments.com and look at rents and make the same decisions.
Well, because eventually these renters are signing leases, right?
Yeah,
they're accepting the rent, and theoretically there are, places that are cheaper. Maybe they're not in the ideal location. Maybe you're not getting that one granite countertop that you really liked. But if you would like that luxury feature, an elective feature, you will have to pay the luxury elective price to live there.
And that's, to me, that's my biggest complaint. And I'm kind of, I don't know if this is a straw man or not, but this does seem to me about an assumption that, okay, if this is true, then it must assume, assuming that renters are kind of trapped and they don't have that ability to make choices when us, being inside the industry and tracking things for so long, it's very reactive, and we have the data that shows that renters, if they see a cheaper apartment, they'll move out next year. It is a slightly longer turnaround than getting gas, which is the other analogy that I want to use. Is like, well, if gas stations probably have a service that sets their prices. That's a very fluid market. So are apartments, a lot more than you'd think.
Yeah.
And so that's
and one other industry, Matt. Let's talk about Live Nation and Ticketmaster.
Yeah.
If we're going to start looking at who's really price fixing and a monopoly that's there are a few other industries that are as decentralized as the real estate industry and the multifamily industry. There are some major players.
Very good point.
There are some big players, but they're not making up the majority. They're making up 20, 30%. Like the biggest guys are I'll grab the apartment association data, but they make up a relatively small. It's extremely fragmented.
Yeah.
So it's not like there are no monopolies. And another argument is saying, okay, well, in one town, maybe somebody owns a lot of the apartments.
And that's the other assumption too, is that RealPage is pulling the strings, and apartment landlords just do whatever RealPage says.
So if there's one pharmacy on the corner, or if there's one pharmacy owner in a town that owns both of the pharmacies, or one bank.
That's why I said if there's two apartments across the street from each other and they have the same amenities, don't you think that one person's going to, if RealPage tells them both to raise rents, don't you think one's going to come in a little lower and try and get, apartment managers do that every single day.
That's capitalism. That's just doing business.
Yeah.
And if you're offering a product that doesn't have the market doesn't see the value in it, they're not going to buy the product unless there's no supply. And you need to have the higher prices to send the signal to the market that we need to build more supply.
Yeah.
So I'm hoping that there is a sense of I don't know if we're missing something. If there's some big scheme going on, which that does not let us know. But.
And we've talked about this multiple times. It's very easy and kind of fun to talk about because I think it is worth getting the word out on this, and it corrects a lot of people's easy narratives about the apartment industry. But ultimately, it is to the landlords. Sure, if one company owned all the apartments in a city, that's one thing, and he was controlling rent in that way. But that's not what happens. It's very decentralized, and the responsibility should lay on the landlord and not on the software that's giving him information.
Well, that's the thing. The software is just giving a recommendation, and you don't need to take, or often should not take that recommendation because the data is not always perfect.
Yeah.
So you got to be careful. All right. Well, again, give us your comment below. Tell us if you disagree, and maybe the opinion is housing is special in some way, in that. And again, I don't agree with any of this, and I'll tell you why. Maybe housing is special and it should be a protected thing, just like we have fair housing rules and laws, which
I think that price fixing in the world of for housing is particularly disgusting. But I just don't think that it's happening in the way that they assume it is.
Yeah. It's incredible.
And the real lever, I think, for rents rising and falling is, are there new apartments being built, which we have been seeing for the past year, and we'll talk about.
Well, let me ask you one more question before we move on, Matt. Yeah. If landlords did not increase rents in 21, 22, what would have happened?
Well, then we wouldn't be building as much, I don't think.
Well, and how much distress would there be?
Yeah, there would be more distress. there would be.
Let me ask you another. Or were those rent increases justified?
Relative
to the increase, inflation, the rise of utilities, property taxes,
could arguably,
insurance, debt service,
Yeah.
payroll, materials. It's not like apartment owners are making bank right now.
I don't even.
And so if we didn't have the rent increases,
Yeah.
people would be out of business.
People would be out of business.
Banks
no
would go
one
back
would
to
wanna
banks.
Invest. There wouldn't be things. There wouldn't be new apartments being built. It would be, and we've seen this regionally in places too.
But it's even worse than that, Matt.
Yeah.
You have foreclosures. You have bankruptcy. You
Yeah,
get
yeah.
worse management because banks, all of some properties are in receivership, and they're hiring whoever third party manager that doesn't care. They're just trying to maintain. You have banks that fail that can potentially bring down the entire U.S. financial system.
Yeah.
That's how important it is. And so you're saying, well, housing is special and we need to make sure, and this feels wrong. Because I have these feelings inside because, my cousin, leased a $2,000 a month apartment and he can't afford it. And now it's when he could have rented a $1,200 a month apartment.
I think about it. I don't even really think about prices raised because expenses raised. I think that something did happen, something exceptional happened during the pandemic, and demand raised, and that's why the prices.
If landlords could just raise rents 20%, wouldn't they? Don't you think they'd just do it again if they could?
Yeah,
It wasn't that
exactly.
landlords were like, look at this. It was because again there was so much demand. All of our properties were 100% occupied. What do you do? Okay, well I guess you need to increase rents. Obviously, there's too much demand. We can't service everybody.
Yeah.
We need to, offer to more people. Okay, we need to increase rents. I have a responsibility to my investors.
Yeah.
I have a responsibility to my lender. To everybody.
Yeah, there are people willing to pay for it, and again, I really think it's worth stressing. Apartment market is a much more fluid market. It's not like there's only 4 apartments in any given metro. Now, some small towns that may be the case, but for the things that they are talking about, we are talking about. A vast ocean of options that are available to renters, and that renters have the choice and the information available to them as well.
Yeah. So again, we need to not have a centralized, top down, no technology because housing is special.
Yeah.
Again, I hope grocery stores don't use it for food to figure out how much food they need.
Oh no.
See, it's not like that's essential. Should we have a right to, again, do you have a right to housing? Do you have a right to food? Do you have a right to water? I don't know. I don't know who gives you these rights.
That's and it quickly
them.
devolves into okay. So what would the fix for this be? That you can't use an algorithm, or would the fix for it be, all right, we'll tell you what the rent is, because it gets awfully close to that.
Yeah. So I'm not really sure. I don't know what they're trying to solve for, other than for a political win.
Yeah, I think so too. You were saying, is there a crowd? I was like, no, it does seem like they just don't have the facts, and they're going on maybe a little bit of feelings.
Yeah. So if we don't have the facts, if we're going on feelings, let us know
Yeah.
in the comments. Because obviously, we're riled up about this. Okay. National Association of Home Builders, Matt. I see single family and multifamily production is headed in the opposite directions across different geographies.
Yeah. So
what gives?
This is there. The point of this is actually about the regional distribution, not specific places, but actually types of places. Like, how much are apartments being built in large metro core counties, suburban counties, small metro core or outlying counties? And the upshot of this, what I think is a lot more interesting and delves into where we are right now with the multifamily market, is that construction activity is down across the board. Sure, there are regional variations that we can kind of get into, but construction activity is down 24.1% in large metros, 20.7% in the suburbs, 23.9% in the outlying counties, 18 and 19 in smaller metros. So construction not only is down, and I kind of downloaded the data on this, it has been down for this is the 4th quarter it's being down. And if trends continue, and there's every reason to think that they will, we will start to see compounding declines in multifamily construction. And that means Lower construction now means less new supply later. In short, we are looking at some concrete signs that the currently massive wave of newly built apartments will recede. Apartment supply and demand is going to rebalance, and I think that should lead to improved performance for multifamily assets, a little bit stronger rent growth, and you know, a little bit more breathing room for operators. Yeah. And really, this is also a reminder that some of these trends, when it comes to the investment market, the construction market, are not necessarily connected to fundamentals. I think the reason why people are building less is not because there's a sluggish rent growth, which we'll get into. I think a lot of this is interest rate driven. And so we're looking at these different trends that have coincided and intersected in interesting ways. And you can, at a glance, think that they are maybe more connected than otherwise. Now, I am interested in how it affects the market, because you look, so if you're trying to buy a multifamily property and you've seen, you know, a past year of sluggish rent growth, that cap rate and that, you know, on the T12, or that's going to look a little bit, the income's going to look a little bit worse than it would have maybe in 2021. And so that's like a mechanical way that prices could be affected. However,
and what's that, you bring up a really good point, because, you know, the real-time fundamentals, you know, related to how if you're using a cap rate to determine the value rather than just what it's worth, if you're looking at it based on, if you're driving the value based on the income or the net operating income, if you start seeing these hits to net operating income, and buyers want to see a higher cap rate, but, you know, your property is going down in value. If your income's going down, you know, if your value stays the same, you're like, okay, you know, I'm trying to sell it for whatever. Your cap rate is going further and further down, which makes it harder for a new buyer to purchase it, because like, I don't want to use negative leverage.
Yeah.
I mean, on the property that we're under contract for right now, Matt, at Solana, you know, it was a little bit of a challenge, and it took us a minute to kind of wrap our heads around, is that they had like a big drop in occupancy because they lost a big corporate lease last year. And it ended up being, you know, an additional, like, I want to say another like $60,000 or $70,000 in monthly vacancy loss. And so it was, and then they took a little bit to finally lease back up. They got it leased back up, and it's performing well now. Yeah. But, you know, those one-time events, it's like, how do you calculate that? Because there's different ways to do it, and you can normalize it, you can annualize it, you take that month out, you know, there's ways you can do it. But on face value, it's like, oh, well, this puts it at a cap rate that on, again, face value looks unattractive. But is that representative of, you know, and it's been a challenge also as, you know, as property taxes have increased or insurance costs have increased. You have to look at their T12, the financial statement, and say, you know, are they using, you know, kind of normalize, if we even know what that is, but more like, you know, have they been hit with a reassessment? Have they seen their insurance increase yet? Because if not, you have to bake in that you're going to see that. You can't say, well, they've been paying X on property taxes and Y on insurance, and we should be able to get a similar rate. I mean, always on property taxes, you know, you might get reassessed. But if you haven't, it's almost much more of a certainty of like, you're going to probably get hit with a reassessment. Like, are you ready to appeal? And are you ready for it to go to, if it's fully assessed? And on the insurance, I mean, we've seen, it's insane, the insurance rates. And we're in the Midwest, so it's cheaper than the coast.
I was gonna there, but it's still the past couple of weeks. It just didn't make the cut. I wanted to talk about insurance and how that's affected the market.
We're paying triple what we paid a couple of years ago.
Yeah, the fact that insurance rates continue, and we were talking about this in 2023 about the long tail of inflation. It happens also insurance. We were talking about early 2023 and how like this is because maybe the price of nails goes up in 2022, and then the insurance company buys it then, and then they factor that into their 2023.
I think that maybe that's how.
But the fact is, those same pressures seem to be continuing. There's something that is driving this continued insurance increase in a way that was kind of unexpected for me, because inflation has gone down.
I mean, we put insurance on a property that, it was the same carrier and the policy doubled. What has changed? This is the risk has doubled. You know, why are you looking at it such a different way? And there's a lot. could be a whole episode. And the more I learn about insurance, the more I learned I don't know that much.
Well, and also the more we learn that we're not alone in this situation, that across the board, particularly in some of these locations that may have more natural disasters or something like that, where it's just they are collectively things are riskier, I guess. But in a place
and they're making like a place like Indiana kind of like make up for that a little bit.
I wonder about that. Yeah,
well, because it's like there's obviously a ceiling. Like there's a level of where it's like can no longer. And Florida's experienced they're through the ceiling a little bit, and so they're like, okay, no more blood from the turnip that we can squeeze. Who else has got some room? Midwest, you guys have actually had some good rent growth, doing decently well. You'll be fine.
Yeah,
I think that is a lot of it.
It does seem like there is a lot of there's a little bit of a certainty about some things, some struggles right now, especially with insurance. Fundamentals don't look. This is what I told you in the summary beforehand. I was like, well, our fundamentals don't look great. Investment sales are down. Does this mean that we're in a bad place? But I think that any multifamily investor worth his salt is going to be just like you looked past that corporate rent. It's going to dig into it and realize, oh, wait, no, actually construction's down. So that means in a few years, things are going to pick up. I know what's going to happen to interest rates. I will pose this question openly in the comments. If you think that runaway inflation is more likely than interest rate hikes, please let me know. But I think that, it's a fairly good bet that interest rates will go down, whether it's in the next 6 months or the next year. But that is a certainty for people. And I wonder if that is making people hold on. Whereas last year, I think people held on and didn't do anything because they didn't know where it was going to go, whether it would go up or down or what would happen. But now it's like if I can just hang on for just a little bit more, then they can get the price that they wanted.
Yeah, I think some people aren't seeing the pricing that they wanted, just because whether it's they're in the market or they're not getting the. I mean, you have to go through a lot of deals to find the price that you want, and it's different segments. I mean, there's areas of the market, the middle market, multifamily, acquisition space that is more crowded than others. Yeah. The mid-sized small deals are going to be more crowded. If you think about all the syndicators, new shops that have opened up, and it can be kind of difficult to raise capital right now. And so, you're not trying to do a massive capital raise. So you're going to be looking at the, slightly older vintage deals that are in the $10 to $25, $30 million range, or even less. That's going to see a lot of the competition right now because people are getting after it. They're going after those deals. They're not necessarily taking on the larger properties, the more institutional deals, because a lot of the institutions have been on the sidelines.
We'll look at in just a second here.
And that's where we've seen at Great Capital, that's what we've seen as an opportunity is, let's go into some of these bigger deals right now. While everyone else is frankly a little bit nervous about raising the equity and the money to do it, which, I mean, it's way easier said than done. It's not easy to do. I mean, a lot of what I'm focused on right now. But we've been able to get really good pricing because there just hasn't been many buyers. Call it, north of $50-60 million for an asset. It's not a very crowded field. Not that they're not great assets. It's just there's no.
Why? Why do you think
people are on the sidelines? And there's a concern of where the money's going to come from. I mean, we're raising almost $30 million, Matt.
Yeah. Where's
that money going to come from?
Surprisingly, more places than you. I was. Well, I'll say that I was surprised in the interest, or I was pleasantly surprised, even though I thought it's going to be really, really easy to get investors for such a beautiful building. But even then, it has surpassed my expectations. There are people that are still interested, and I keep thinking so. If there are people that can look past the snapshot that we're in right now, what is holding back the institutions? And I think it's maybe just this kind of committee that they have to take it to or something.
But Blackstone's going all in right now. Blackstone's absolutely re-entered the market. I mean, they keep putting out materials saying this is absolutely the time to get in. And we're going big, and they're going to gobble up, another, however many hundreds of billions of dollars of assets over this cycle, and they're going to be even bigger than they were in this last cycle. And I think that the deals of the decade are going to be done this year. Maybe a little bit next year. But it takes the ability to say this year, the next year and a half may be slow. we're going to see a lot of supply coming online, which means we're going to see elevated vacancy levels. We're going to see rent growth be not as fast, and we don't know where interest rates are going to be.
Yeah.
Like you said, maybe they'll be lower, but maybe not. Maybe it takes 9 months. Maybe it takes 30. Who knows? It's unknown. You have to get past all of that and say, okay, well, that's again, 2 years. Being conservative, we got 2 years of lower growth, but the pricing right now is really low.
Yeah.
And so, do you wait for pricing to most likely recover? Because I don't think there's going to be this Goldilocks moment of where the pricing is really low, or so the pricing is really low, and the interest rates are really low, and the rent growth is there.
Yeah.
Like, people are smart enough.
Well, yeah, and it's got to look risky to some people. Otherwise, they wouldn't. If it was a sure thing, the prices would be higher.
It's as simple as that. It's as simple as the Warren Buffett's. Be fearful when others are greedy, and greedy when others are fearful.
Yeah.
So when people were greedy in 21 and 22, you should have been a little bit fearful.
Yeah. And I think you can look back on previous Gray Report episodes, and I was a little bit like, okay, what's the limit here? And we were
we didn't know what was going to happen, but I mean, again, just judge us by just like the actions that we took. We just stopped doing a lot of deals. We were still looking for opportunities. We bought low,
and we were saying the same thing about like, here's an opportunity. It's going to be struggles all throughout 2023, and deals didn't come up, and that's better than
not that we were right about everything.
Yeah.
At all. I'm sure we were wrong about a lot of stuff too.
Yeah.
But generally, now is the time to, I think, to take the leap of faith and say, all right, now we can get in at the pricing. Maybe we're not going to see the big growth for a couple of years, but we will but if you want to capture that growth at the low basis, you have to get in now. You're not going to, I think it's wishful thinking that you're going to be able to get your cake and eat it too.
Yeah, yeah. If you want, we can. I would like to give some specific numbers about the investment sales from this Newmark study.
Yeah, let's hop back on over to that.
Puts it in a little bit of and these are just now. This is a 72-page report, and I'm only reading the summary here. But I wanted to. I wanted to share these numbers because it does speak to the reticence, at least in Q1. Now things may have improved, but investment sales are still down. And they haven't bounced back in the way that it was looking earlier. Investment sales declined 22% year over year in the first quarter of this year. They're negative 35% compared to the pre-pandemic average, 2017 to 2019. Office sales actually rose 25% year over year, and all other property types fell. So this isn't like this doesn't speak necessarily to like the fundamentals of these markets, I think. Liquidity has been strongest, they say, for smaller transactions, just like you would say. So we're really on point, aren't we? Deals.
Yeah, try, man.
Deals under 100 million made up 66% of volume traded in the last 4 quarters. Institutional investment remains anemic, down 55% year over year in the first quarter.
Wow.
I'm not sure, again, how things have changed in the second quarter, but these anemic sales are a test. This is, I don't know if I said this yet, but it is like that scene in Braveheart where the enemy is coming and he's saying, hold, and I think that a lot of people are holding, and you just don't want to, and a lot of people are a little bit scared of the timing of this, and this is not a time to cut and run by any means. I think that we're at a confluence, again, of below average rent growth and very below average sales, but these things are not as related as you might think, and the real levers for multifamily rent growth is supply. Most multifamily investors are optimistic, I think, about the fundamentals and the long-term demand for housing. So this current slump, we know it is finite.
I mean, we're going to get this on a later report, but absorption is really great right now.
Yeah.
If it wasn't for this, now it's like 50-year high in supply.
Yeah.
We rocking doing gangbusters, and again, it's because interest rates are zero. We have all this supply right now.
Yeah. And that's what I was wondering too, is like, or another thing I'd rather is what's going to move faster here, interest rates or prices. I wonder, if inflation isn't running away, you can expect a rate cut. Are owners going to raise prices, or are they going to, I feel like some owners just have that set price in their head, and once they get there, then I think there's going to be a little bit of lag.
I think there is too, because I think that there's going to be, I think that interest rates will come down before the the short-term fundamentals improve. So I think we're going to see higher vacancies, we're going to see slow rent growth, and we're going to have a little bit more supply that's coming online, and people are just going to be kind of beaten up and set, and then all of a sudden they're going to be looking for 6 caps or six cap rates and above, because that all of a sudden that's what their mandate has been. And as we've seen, when as insane as it was when interest rates increased and prices stayed high, I see no reason to expect, really, a big change in that. I mean, it's going to move, because I think there will be some folks that, hey, I can make this work. Like I'm going off my returns. I'm not going to stick to, whatever Post-it notes on the wall right now, because the market's changing. I have to adapt a little bit, and I'll accept a, mid-5s cap rate, because my interest rate has come down, commensurate with, where cap rates were. So, I'm borrowing at I'm borrowing at 4.5%. So now I'm okay buying a 5.5 cap. Versus where if interest rates were at 6, I would like to have been at least 6.5, but really wanted to be at a 7 or something, which just isn't happening, which why deals aren't getting done that often. So it'll be really interesting, because there is a lot of pent-up demand on the investment side. I mean, think about all the office investors who, if they didn't lose their shirt, are like, I'm not investing in office right now. I need to invest in multifamily. And this is a whole other topic, Matt, and I apologize for jumping here to there. Fine. But it's about the investor base, and more and more people are understanding that alternatives, and specifically private real estate, is more or less an essential part of anyone's portfolio, their overall investment portfolio, along with public equities, stocks, and bonds, and maybe a little bit of cash. But real assets, again, specifically cash flowing assets like real estate that are less correlated than public markets, can decrease risk and increase return over time by having a higher Sharpe ratio and further diversifying and uncorrelating your portfolio. Every family office has 15 to 40% in like real estate. Sometimes it's alts, but a lot of times it's like 30-40% of real estate in their portfolio. And where that matters is who have become very well aware, and they're picking up the pace to get locked in and figuring it out, is all of the our registered investment advisors, RIAs, or wealth managers, whatever you want to call them. Their clients are demanding that they get them into private real estate deals. They're taking our deals, or they're taking whoever, whatever syndicator that they're having a conversation with, because they want to get into this, and they're bringing it to their money manager. And their money manager, who often isn't a real estate expert, they're dangerous, and they've seen deals. They're looking through it, and they're like, I don't know what I don't know how to give you advice. It looks good, but I don't, they're a little bit out of their element. Some RIAs have been ahead of the curve and have specialized a little bit, and who offer these types of real estate offerings to their clients. In addition to, hey, I got you this mutual fund, or whatever the product is they're offering. I'm going to get you some munis. They're saying, hell, now we've got this real estate deal, or this real estate fund. And
or we've got
all the reasons for you to do it, and all the clients are coming into it. We work with RIAs today who do that, and the reason RIAs are doing it is because they need a way to differentiate themselves from everyone else. Everyone can offer the same 60-40 portfolio. Everyone's got a very similar, growth-oriented or defensive, the mutual fund or collection of, a portfolio that that's copy and paste to put you into. Are you in growth mode? Are you in conserve mode? Are you in the middle? Here's your 3 options. Pick a color. And people are like, I want a little bit more flavor. I want a little bit more excitement. And real estate makes sense. I can understand real estate. I can understand apartments. And so if they've realized if they can have these unique offerings, they can keep engagement up with their clients, but also attract more clients, because they're their clients, and tell their friends. They're like, yeah, I got into these real estate deals. They're really cool. I'm getting cash flow. It's kind of cool. Yeah, I own this apartments over there. And so it's a way to get folks in the door. And I know there's a couple that were way ahead of the curve. They got started about 5-7 years ago. But I'm having conversations every week with other RIAs that they're trying to figure it out. And they're like, okay, well, if we're going to do it, we need to do this the right way. And so, I need to bring on a real estate expert, and how do I get them on my platform, and how does, your reporting show up on my brokerage, my Schwab brokerage statement. All of the the details and the admin work has been preventing them. But so I'm going to come back to why this is all important related to transaction activity and the pent up demand. Yeah, that's all bubbling up, and those groups have been kind of out of the market, now over the last year, sort of, because of uncertainty of interest rates. They're looking at more private credit, some preferred equity, but they're going to be coming back into common equity pretty soon. Some already are, and that's kind of new capital that's going to be flowing into real estate or multifamily. And again, all the office investors probably aren't all going to be investing in office anymore. And so I'm not talking about individuals. I'm talking about pension funds. I'm talking about banks. I'm talking about sovereign wealth funds. Big money. Where's that going to go? It's going to go into multifamily. It's also going to go into industrial. It's going to go into data centers, cold storage, things like that. So I think we're going to see a nice pop, but the speed of it, we just know as so I lay all that out, and so it's okay, it's going to pop up real quick. Real estate moves slow. Right, and so we just can't get away from that.
That's what I was writing. I think that the price increase lag will be much shorter than the price decrease lag has been.
I think we're on the same
It'll
page.
Be just like a blink and you miss it kind of thing, and it's like, and it may be, it may be a month.
Well, it takes one transaction doesn't move the whole market, but I think you'll start getting some data points pretty quickly. Yeah, of like, oh damn, that deal traded for a 5 cap.
Yeah. Totally agree.
Everyone's going to be like, what are they? Everyone's not going to be able to believe it. And so it's going to be fascinating, but I am confident you have to start getting into the market now. Yeah. Again, you can't be,
much easier now than to.
You got to buy the rumor. You can't be buying the news.
Yeah. Agreed.
Too late. So.
Yeah.
All right, Matt. Where would we like to? Let's go to the CRE report.
So these two reports, and I'm going to be kind of freestyling this because I don't have, but I did read them, and the gist of both of these reports is that May rent growth was a little more modest, or sluggish, as the apartment list report would say.
Don't sugarcoat it, Matt. I mean, right now we should be in peak leasing season. We are in June. We should be cooking up. I mean, June. I mean, really, starting in March is when it begins. But then, every market's a little bit different. Every property is a little bit different of when all the lease expirations are, and this is driven by. It's lease expirations. Most of the leases expire in the summer months is because people want to have their lease in place before school starts. In the fall, get settled before the kids go to school. Makes sense. So you got all these expirations. That's where you're going to see as leases turn over. That's where the rents will reset to the new market level. And so if you're seeing some increases, that's where they would show up. We're barely positive, Matt, in many markets, and year over year, I believe we're negative still across the United States in many cases, and so it's a big disappointment for the idea. It's not surprising when we talk about supply, but it's a disappointment for those that were forecasting strong or any pickup in recovery to rent growth in 2024. It's a little bit better than it was last year, but still, it's just if we don't make up the gains in the summer, is we will see some negative growth in November and December. Certainly December, maybe January. You always see a slowdown in those winter months, and you have to have the gains to make up for that. It's 2 steps forward, or it's 3 steps forward, 1 step back. But we've only taken 1 step forward. We may take another step back.
Yeah. So, like for instance, Yardi Matrix has month-over-month rent growth at 0.3, and typical rent growth is around 3%. And so if you extend that 0.3 to 12 months, you'll get to that close to that 3%, but you can't extend this 0.3% to 12 months.
This should be the peak.
Yeah,
and
it really should be.
This should be the peak, so you should be seeing well over 3%.
And at the moment, Yardi Matrix has 0.6% rent growth year over year.
Okay, so it's a little positive.
It's a little bit positive, but it's not, it's vulnerable is what it is. Again, things are lower than pre-pandemic averages right now. These are a little bit of a test, and I think that it is interesting that Yardi Matrix, just as we were talking about is mentioning how investors are looking for deals and opportunities at this moment. They are framing it in a way that, well, if Sunbelt's not cash flowing, then you may look in the Northeast or the Midwest. The quote there is although these Northeast and Midwest markets have their own set of challenges and can't match the rapid growth of the Sunbelt, apartment demand has stayed strong while supplies remain muted, keeping occupancies high and rent growth steady in the Midwest. And these metros benefit from reindustrialization of the economy and affordable rents, while Northeast benefits from return to office and rising immigration. There is some regional strength in the Midwest, as if you're looking for some resilience, they're very reactive. The ones that are changing the most, I guess, are your Phoenixes and your Tampas. They are suffering a little bit now, and comparatively, Columbus, Kansas City, Chicago, even doing okay.
Higher they climb, the farther they fall, Matt, and that is so much the case for the Austin market, really leading the list of the worst rent growth, rent declines in
across
the nation.
The board. Wow.
Followed again by. It's basically your average multifamily syndicator or out-of-state investors' favorite markets.
Yeah.
Starting at the bottom with Austin, followed by Atlanta, then Raleigh, Orlando, Phoenix, Charlotte, Tampa, Nashville, Dallas. I'll stop there. But I mean, those are some of the favorite markets for multifamily investors to invest in, Matt. Tons of syndicators and LP dollars were thrown to those markets. Tons of new development they have to work through. And I guarantee you, anyone that bought real estate in any of those markets in the last 3 years did not peg negative rent growth in 2024.
Yeah.
And they are all experiencing negative rent growth, with Austin seeing the deepest declines, well over 5%. Scary if you bought at peak pricing in the Austin market on short-term debt or any type of debt, to be honest. On the top of the list, New York City, Matt, has been it's been punching really strongly over the last, really several months, probably like the last year or so. New York City, saw major declines back in the pandemic.
Yeah.
So some of that is making up for this, but there is a lot of work from home trend. They're kind of making up from a lot of negative growth.
Yeah.
But some of these Midwestern markets, what's unique about them and really fascinating is that they're compounding growth. Really, none of these saw any losses. So this growth is compounding on gains as opposed to making up for losses.
Yeah.
Columbus, number 2 in the nation, right at 5% rent growth, followed by, just below 5% rent growth, followed by Kansas City. Then we've got New Jersey, I assume similar dynamics as New York City. Then Washington, D.C., also a little surprising. I'd probably put that to return to work as well. And then Chicago, Boston, Detroit, Philly, and Indianapolis. It's an interesting dynamic, Matt. Indy was at the top for a while. Obviously, we can't stay at the top forever because, again, we never saw the declines. Markets like Columbus, like Kansas City, like Indy. We didn't see declines during COVID. We didn't see declines during 2020. I mean, it was slow, very slow growth, but sometimes slow and steady wins the race.
A part of me does think that the rents in Indianapolis aren't an island or Columbus for that matter. They're not. They are a little bit subject to national trends, but they are independent of them, and every market is different.
Yeah, every market, every sub-market, every neighborhood, every block's a little thing going for it.
But that being said, it's like it is worth keeping track of the Sunbelt and almost a little bit cheering them on, because once the Sunbelt starts to improve, then that could be used as a forward-looking barometer for the return of the national market.
As a Midwest investor, not buying anything in the Sunbelt, but if I was located in the Sunbelt, I'd be looking for picking up some huge deals right now, because everything we said that applies to a recovery, it's going to happen in the Sunbelt also.
Very good point.
It's just, are you catching a falling knife? How much supply is still going to be coming online? You just got to be careful. But I also think a lot of real estate investors are so loaded up with Sunbelt deals that it's a hard pill to swallow, but could be a time to kind of double down into some of those markets.
And again, that's been the story is supply. Where are they building? They were built in the Sunbelt. And it's not because people don't like to rent apartments anymore in the Sunbelt. It's just because of supply. And we know where that's going. So.
Yeah. Absolutely. All right, moving to the apartment list, just looking at not the same data, but data from a different source.
Yeah, it's kind of complementary for what was covered in Yardi Matrix. They actually found a little bit stronger month-over-month rent growth at 0.5%, but their year-over-year rent growth is a slightly negative at negative 0.8%, I believe. That is not good. And if you look at the month of, this is, again, one of my favorite charts I like for every month that shows, okay, this is how month-over-month rent growth looks now. And if you track that back to 2019, the pre-pandemic number, that was the peak rent growth month was May.
Yeah.
And now we're not. This is the third lowest rents, and rents have been declining on every month. I'll admit I was wrong. I thought that we would have healthier rent growth. Now, we're not hugely in. This is not like emergency mode. If anything, this is still continued resilience, and it's a small difference, but it is it is a trend that adds fuel to the fire somewhat, that this wave of supply is having an effect.
Yeah. Now as it would be, not surprising.
And now this isn't in the apartment list report, but it was in a couple other reports that I had to cut for time. Mm-hmm. One from Institutional Property Advisors, which said that they said that absorption is reached a record. Now I don't know what record. It was like record absorption. It was like or the biggest absorption on record is what they said. I was like, oh well, but regardless,
we've been keeping records for how long?
It's a big number. Yeah. Exactly. And the similar point was made in another report from. I believe it was NAR, talked about how multifamily absorption is 55%. Multifamily absorption doubled compared to last year.
Yeah.
So however you slice it, it is
and I mean, to me, that tracks the fact that we have any positive rent growth with 50-year record supply.
Yeah.
I mean, the absorption has to be cranking, and there has to be a ton of demand to be able to fill that.
Yeah.
I mean, again, we would see more declines. We'd certainly see larger average national declines. The fact that many markets that are experiencing the highest supply levels in 50 years that are still positive.
Yeah.
I mean, that's a major, I think, again, testament to resiliency, and whether that is, household formation, renter preferences, or just the lack of affordability for sale single family homes.
Yeah.
I think it's probably a combination of all of that, and then it's still shaking out some of the whatever feelings we had from COVID and the pandemic, and
I think
getting out of that just abnormalness and back to some sort of normalcy.
I would expect, a little bit. It's a combination of things. Supply is one, and I think there was a reaction to high rents probably from the renter base a little bit. But again, these are finite things, and the regional differences tell that story as well. If the fact that a place like Columbus is doing so much differently than a place like Austin is evidence that, all right, this is defined by how many new apartments are coming online and how many other ones, because all signs for housing demand are positive. Even home price growth, which I've been reading some headlines that have been saying like, buyers are getting back in power in the housing market, which may be the case, but home price growth continues according to the hard data. So
I love following the people who continuously talk about the impending real estate crash and single family homes, and all real estate in general, but there's so many doom.
They wrote the article,
they wrote the article
15 years ago,
and they didn't buy a house, they missed out on buying a house, and they're frustrated, and they're like, look at this data point. I mean, it happened all throughout COVID. It was like, wait for this, there's going to next May, next June, it was like the crash is right around the corner, and corrections will always happen, but it's just they've cried wolf so many times.
And I agree. And that's a really good point, though, is despite the current conditions as different as they were during the height of the pandemic, one thing that has been consistent, even amid the more volatile, I would argue, multifamily market and rent growth, is home prices have just continued to get higher. I think to me that speaks to housing demand. I would love to see a report on the tangible effect of interest rates and how it maybe drives permanent renting or something like that. But housing demand is housing demand, and that's one of the things that people should be thinking about when they're considering, the timing of multifamily investment or really of housing in general. Is like there is a boatload of demand just waiting to be unleashed, and it's not going to go away. And I think that the absorption numbers are proof of that.
Yeah.
Regionally, I do want to look. Oh, unless we've got a hard cut. All right. Well, that's I think ultimately that is like my summative thoughts and feelings. Just kind of coming back into here is that this could be a particularly exciting moment.
Yeah.
And it's one where it's worth paying attention. I think that we paid pretty close attention throughout 2023, and the moment to really kind of keep your eyes open is right now, because pretty soon it's going to be in a blink and you miss it phase, and you don't want to miss it.
All right. Thanks, everyone, for watching this episode of The Gray Report. Make sure you subscribe and watch the next episode on YouTube.